If you invest in individual stocks, then you need to understand the company's cash flow statement. But what is it, and what does it tell us? The cash flow statement hasn't always been a feature of a company's annual report. It has only been formally required in the United States since 1988. Today, the cash flow statement is one of the three main financial statements. We've already covered the income statement and the balance sheet. The cash flow statement shows you the cash inflows and outflows of a business. That is, how cash came in and went out of the business. The cash flow statement, like the income statement, will cover a period of time, say the 31st of January to the 31st of March. Why is the cash flow statement important? There are two main methods of accounting. There is cash accounting and there is accrual accounting. Accrual accounting is what you see on the income statement. The accrual accounting method records revenue when it occurs and expenses when they are incurred. In cash accounting, revenue is recorded when the cash is received and expenses are recorded when they are paid. Let's say you sell a shipment of shoes for $1,000, but payment isn't due for 30 days. On the income statement, which uses accrual accounting, the revenue is recorded as soon as the order is placed, even though they haven't actually been paid for yet. On the cash flow statement, which uses cash accounting, the revenue isn't recorded until the actual cash hits your account. How to read a cash flow statement. You now know what a cash flow statement is and why it is important. But how do you read one? The cash flow statement has three main sections: operating activities, investing activities, and financing activities. Operating activities include the cash used and generated from the company's core business, the core business being the main way it makes money. Investing activities includes the cash used and generated from investments. It includes things such as purchase of property, plant and equipment, investments in other companies, and acquisitions of other companies. Financing activities include cash raised from investors or lenders to fund the business. This includes things such as issuance of debt, repayment of debt, payment of dividends, issuance of stock, and repurchase of stock. When you read a cash flow statement, positive numbers are inflows of cash, and negative numbers are outflows of cash. If we add up the cash from operating activities, investing activities, and financing activities, we get the net change in cash for the period. Next, we have the cash at the beginning of the period. Add the net change in cash for the period to the cash at the beginning of the period, and you get the cash at the end of the period. If you look at the cash flow statement of different companies, you might notice that they are laid out in different ways. That's because there are two methods to create a cash flow statement: the direct method and the indirect method. Whether a company is using the direct or indirect method, the changes will appear in the operating activities section. The investing and financing activities sections will be the same for both methods. The direct method starts with cash receipts from customers. Then you subtract cash paid to suppliers, cash paid to employees, interest paid, and taxes paid. At the end, you get the cash inflow or outflow from operating activities. In the indirect method, you start with net profit or loss, which is taken directly from the income statement. You then add back all the non-cash expenses. Non-cash expenses are expenses that are recorded on the income statement but where no cash flowed out of the business. Depreciation and amortization and stock-based compensation are the most likely culprits. We then add or subtract changes in working capital. Working capital is the difference between current assets and current liabilities. Working capital includes changes in inventory, changes in receivables, and changes in payables. These might sound familiar if you watch my video on the balance sheet. Add up all these items and you get the net cash inflow or outflow from operating activities. While the direct method may look simpler, the indirect method is easier for accountants to create, and so it is more common. In this lesson, we learnt what the cash flow statement is, why the cash flow statement is important, the difference between accrual and cash accounting, how to read a cash flow statement, and the differences between direct and indirect method for creating a cash flow statement. In the next few videos, I'll be going through each of the sections of the cash flow statement and explaining the key items you'll find in each. I'll then show you how to build your own cash flow statement. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.